Hello YouTube, this is Jerry D in Tennessee. It's a rainy night and I thought I'd do this little quick video about averaging down the stock. Sometimes it can get you out of trouble if you're upside down in a trade. You really don't want to have to do this because you end up spending more money to make money than you normally would. So, for an example, GameStop. I was trying to get in when it first started spiking, the past few weeks ago. And I couldn't get into the stock. I'd set an order to buy into the stock and the price would go up. I'd go change my order to a higher price. The price would go up. And then I kind of thought, I need to quit doing this because the price is eventually going to quit going up. I'm going to get stuck in the high price. The stock's going to drop, and I'm going to be stuck. And that's what they call a bag holder. So I stopped myself, and I just didn't trade GameStop as it was when it spiked the other week. So it's harder to do with a stock like that because GameStop hit $300, $400 a share. That's a lot of money to be trading around with. And I kind of imagine that a lot of you people that's watching my channel may not be putting that kind of money into stocks. My guess is you're probably dabbling in penny stocks. So usually when people's doing swing trades, a lot of people, if you're buying stock like Johnson & Johnson or you're buying Amazon, the high dollar stocks, you're going to buy that stock and hold it for a while. You're not looking to flip. Some people might do that, but it's a lot of money to tie up into a stock. So usually people that's doing day trading, swing trading, they're flipping penny stocks. They're flipping the cheap stuff. So I thought I'd talk about how this works. Some people say it's a bad thing to do. So, I don't know. Sometimes you got to judge. You got to judge how you're going to trade, come up with a plan, what you're going to do. And every situation is going to be different. Every trade's going to be different. You're just going to have to sit back, look at the trade, and decide what's going to be best for your position. Okay, so averaging down the stocks. This is how you do it. So, say you buy 500 shares of a stock for $5. Okay, so 500 shares times $5. You're in the position for $2,500, $2,500. All right. The price drops to $3 a share. So you go in, you buy 500 more shares. I mean, you could buy 100 shares. You could buy 600 shares. And it's going to change the average. But anyway, I'm going with 500. So you buy 500 more shares at $3 for $1,500. $1,500. So you bought 500 shares, $2 cheaper than what you bought the first 500 shares for at $5. So now you're in a position, you got 1,000 shares. And you have $4,000 invested. You got $2,500 and $1,500. That's $4,000 invested in 1,000 shares of stock. So what that does, that makes your cost per share out to be $4 a share. 1,000 shares divided by the $4,000, or $4,000 divided by 1,000 shares, it's $4 a share. So what you've done, what happens is the brokerage is not going to say, well, these shares were at this price and these shares were bought at that price. They're going to take your whole number of shares. They're going to give you an average down price, and that's what your price per share is going to be when you sell the stock. It's what's going to happen. Because it's just simpler for them to do it that way. It just makes more sense to them. And it's still the same amount of money, okay, that you've got invested. You've just dropped the price per share down by buying more shares at a cheaper price is what you've done. But they're taking your total investment and dividing that by the number of shares you've got to get your average cost per share. And that's what they're going to go by when you sell the stock. Based on, what you got into your total number of shares versus what you're selling the stock for. So, now if the stock goes to $6, it spikes again, okay? You hold the shares after you get 1,000, the stock goes up to $6. Now, if you sell all your 1,000 shares of stock, you're going to make $2 profit per share. And this is just that simple. That's how averaging down your stock works. They will, even when you look in your portfolio, your 1,000 shares of stock are going to say that your average cost was $4. And that's what when you sell the stock, they're going to consider that's what you have invested in your stock. And when you make the sale and you sell at $6, you're going to make $2 profit a share. So you'll sell the stock, so that would be 1,000 shares at $6. You'd sell the stock at $6,000. You'll make $2,000 on the stock. Whereas if you just dump the stock, say the price had dropped to $3 and you just dumped the stock, you lost $1,000. But by buying 500 more shares when it dropped at $3 a share, by buying more stock at a cheaper price, you've dropped your average cost for each share of your stock and enable you to make money the next time it spikes. You make more money. So, and that's a simple way of thinking about how to average down the stock. You hear people talk about that in YouTube videos when they're talking about the stocks. Or if you see Tim Sykes, he'll say he averaged down. He bought and he averaged down on his stock. That's what he's saying. He bought more shares at a cheaper price to get his cost per share down. So if it spikes back up, he's going to make more profit off each share. And that's pretty much how it works. So I appreciate you coming checking it out. I thought I'd mention this just in case you get into some of these penny stocks and the price, you get in a little higher than what you expected. The price drops. Penny stocks is easier. I mean, if you're buying stocks for 10 cents, 50 cents a share, it's easier to average out your price per share. It's easier to do it that way. So, and you get into something like what GameStop was. GameStop was up pretty high. You're going to have some money in your brokerage account to average that out. The best you might hope to be able to do is hold that stock and hope it spikes again, or just count your losses and just sell and take your loss. But eventually you're going to end up in a situation, if you trade stocks enough, it's very easy to get on the wrong side of the trade, especially if there's you get a lot of motion in the trading, you're all excited, the price is going up, and you're trying to get in, and like I said, I was trying to change the price to get in the stock, and I stopped myself, and I said, I'm going to get in too high, and I'm not going to I'm going to lose money on this stock. I'm going to quit. I just made myself quit. And sometimes you have to do that on a trade. Sometimes you have to look at what the price action's doing and, I didn't get in. Let's change the price again. No, that didn't work either. Well, at some point you need to really just say, I probably need to just back off of this. If I can't get into it, I probably don't need to be in this stock. It's going too fast. So especially if one's going up that fast. A lot of times they'll drop just as fast. The price will drop, and then there you are. You know, you're stuck. You're up at higher than what the stock's going to close at the end of the day, and you're stuck. You're a bag holder. You're holding the stock, and you're either going to have to either sell and take your loss, and sometimes it's a good thing. If you made profit in the year, you might want to take a loss to cut down on what taxes you're going to pay at the end, you know, when you file your taxes. I mean, that some people do that. They'll take a loss on the stock, especially if they've been successful and made profit throughout the year. And okay, I've lost this much, and that cuts out of your profit. I mean, it does. It takes, you're pulling money out from under yourself by doing that. But it can also cut how much taxes you're going to pay, because it is a loss. It's a business expense. It's a loss. You do have to file your losses and gains, you know, on your taxes. Remember that. It's getting close to tax time. You need to remember that. The tax man will want to know what you've been doing. And if you don't report it, the penalty for not reporting if you try to evade the tax, paying taxes, if you try to evade it, the penalty will be worse than what you saved by trying to evade the tax. They will make you wish that you had paid the tax. They will make you regret doing what you did, trying to avoid the taxes. But anyway, that wasn't what this video was about. I got off on that on the side. I'm sorry, but this is how averaging down. This is the simple explanation of how averaging down works. You can make it work for you by doing this. You're better off trying to buy into the stock as low as you can and then just sell when it spikes. But if you end up in a situation, I'm just saying, this is a way to turn it around, turn the trade around. And some people do this. A lot of people do this. So some people will tell you not to do it. So this is how you can make it work. This is an explanation how you can make it work. All right, so anyway, thank you for watching my video. Thank you for coming and checking out my channel. I'd love for you to subscribe for the channel. And please, you know, click the like. That's going to help, you know, YouTube's going to push it out to more people, the videos. It helps my channel out. And I hope to see you in the next video. I hope you folks have a good night. Hope you have a good weekend. And we'll see you in the next video. Thank you. Bye. Hey, thanks for coming by. Glad you checked out the video. Hope you liked it. If you like it, please click on the like button. And if you're not subscribed to the channel, would like to invite you to subscribe to my channel. May God bless you, and I hope you have a good day. Bye.